We're half an hour away from the Open in Hong Kong, Shenzhen, Shanghai. You're watching The China Show. I'm Annabelle Droulers with Stephen Engle.
Our top stories this morning: Trump's 104% levy on Chinese imports due to take effect in hours, along with tariff hikes on many trading partners. Beijing signaling it's not backing down.
Asian stocks and U.S. futures sink as the tariff deadline nears. The offshore yuan in focus after plunging to its lowest level on record, with the PBOC easing its grip.
Plus, we hear exclusively from Malaysia's central bank chief as the Southeast Asian nation braces for the fallout from Trump's tariffs.
We are on the absolute countdown this morning to Trump's tariff taking effect. The cost of Chinese imports to the US set to double in just a couple of hours from now. So really just let that sink in and how much traders are on edge as we approach this final deadline. You can see here that pain really coming across the board this morning. Yesterday, perhaps a little bit of a bear market bounce. Today, we are definitely in negative territory across these markets. The Kospi, for instance, you're now down 20% from the July peak, heading for a bear market this morning. The topics as well, the Nikkei 225 down 3%. This is as these tariff nears, and oil as well, keeping a very close track on that this morning, off 3.5%. But importantly, you are falling now to 4-year lows. The Kiwi dollar as well, and we're continuing to track the impact on currencies this morning. The US dollar under pressure, but how a central bank's going to be reading this? We do have the RBNZ decision coming up in the next hour, but right now at 55 cents, you're the lowest going back to the COVID era. Golden Dragon Index overnight. Let's take a look at how that fared, down for a fifth straight session. Continued to see this slide coming through. We've had a lot of commentary coming out on this, but I think a really interesting note from Jens Norvig on our T-Live blog. He is an advisor to hedge fund clients, including Scott Besson, actually, before he became Treasury Secretary, but saying essentially the US doesn't actually really want a deal because what they want from China is perhaps even more of a decoupling. We had the phase one trade deal back in Trump 1.0. It didn't work. This time around, actually, the US is more afraid of China from a military perspective, from a supply chain perspective, and really what can Beijing offer. Taking a look at how Chinese futures are faring ahead of the session today, again, 104% duties. You can see here more downside pressure expected.
Yeah, he's not backing down from that threat, and it's due to take effect in less than 3 hours. You can see the timeline there. Tailored deals is what he's talking about with others, including possibly South Korea and Japan. He's not going to make deals that are off the rack, he said. Tailored deals. We'll have to see what happens, but that clock is ticking down to those reciprocal tariffs and those additional tariffs on China taking effect. President Trump spoke earlier at the National Republican Congressional Committee in Washington.
They've ripped us off left and right. But now it's our turn to do the ripping. That's okay. We're going to make our country even stronger, stronger than it ever was. They don't want tariffs on themselves. And it's very simple. We're making deals and people are paying tariffs. Countries are paying tariffs. Right now, China's paying a 104% tariff. Think of it, 104%.
Well, let's get straight to this story now, bringing our China correspondent Min Lo. And Trump is saying that he's going to be making a deal with China at some point. That's what we heard in the last couple of hours. But really, when can we expect it to happen?
Yeah, he actually said that he is waiting for China to make that call. And bear in mind, this actually is a softening of his tone from a day ago when he said he's threatening to terminate any requests for meetings from the Chinese side. This time, though, he's saying the deal will happen soon, but he's waiting for China to make that call, meaning he's not going to make it first. So will China make that call first is the question. China has said it's going to fight till the end. At the same time, they say they're still calling for dialogue. The problem, though, is China is a country that really guards its pride. And the first two times the tariffs came, China responded with restraint, with less than proportional retaliation. The third time, though, they perceive that as a slap in the face. They responded with proportional tariffs. Not clear at this point whether China will want to be the first to reach out here, because President Xi is in a sort of a bind. If he engages, he could look weak in front of his domestic audience, but if it doesn't, then it escalates things further.
And I guess, China's kind of given the portrayal that they're playing the long game. What's Li Qiang saying about the potential levers that he has at his disposal to essentially weather any midterm shocks?
He didn't elaborate on the details, but he says that China has ample policy tools to fully offset the impact of these external shocks. He said that China's macroeconomic policy so far had already taken into account all the uncertainties and expressed confidence in China's growth. And this is, again, policymakers trying to inject confidence into markets, into the economy, because yesterday afternoon, my phone, the Xinhua app, was just pushing out notification after notification of all these state-owned companies carrying out share buybacks to support the domestic economy. And Li Qiang said this in his call to Ursula von der Leyen, the European Commission president. This call took place just hours before those reciprocal tariffs are supposed to kick in. And it's a call by Li Qiang also calling on the EU to expand that mutual opening up, calling for more dialogue and more cooperation on trade, on digital and green development. So again, a bid to diversify China's trade to other regions and other countries.
That was our China correspondent there, Min Min Lo. And for more on this, let's bring in Einar Tangen. He's senior fellow at the Taihe Institute. That's a Chinese think tank founded in Beijing. And Einar, thanks so much for joining us this morning. You're someone that can really give us a sense check and a pulse check on how officials in Beijing are reading this. How are the tea leaves being read, essentially, and how is China likely to perceive this hardball negotiation tactics from President Trump?
Well, I mean, it's time to bet the bluff. I mean, quite frankly, everyone keeps talking about what's going to happen in terms of their countries. But, let's be frank here. These tariffs are not being paid by China. They're being paid by U.S. consumers. And in 2 months from now, there's going to be war cries on the street. A lot of people who elected Donald Trump because they thought he could control prices will be calling for his head.
So, Einar, you liken this to bad poker playing, like betting into the pot like you have a royal flush, but you actually have pretty much nothing. Are you going with that argument?
Well, no, it's worse than that, because everybody knows what the cards Donald Trump has. And China also, the U.S. can see China's cards. And this is what's so odd. I mean, the idea is that Trump is trying to bluff somebody, but they've seen his hand. And China is calling it. They are absolutely resolved. I've talked to different people. There's still an open, mic in terms of if the U.S. wants to call and back down off of its kind of 50% or whatever it's going to throw next. But it's Donald Trump who looks weak here. He keeps saying, well, I'm not going to talk to anybody. Well, I'll wait for a phone call. These are not the actions of somebody who has true confidence in his direction. And he knows he's getting calls already from congressmen and senators saying, look, there's a lot of heat out there. At the same time as everyone's suffering, we're pushing through this $4 trillion tax cut, which is basically unfunded. It's going to add to the problems of the U.S., not solve them.
So based on the conversations that you're having with officials, then, who's going to pick up the phone first? Is it going to be Beijing?
No, it won't be Beijing. And, there's obviously back channel communications. Both sides will agree that the only way this happens if they pick up the phone together. In essence, both have to save face. But the fact is that it's Donald Trump whose career is on the line here. His ability to control a razor-thin margins in both the House and the Senate depend on these Republicans saying, OK, you can get the deal done. As soon as their constituents start calling them, I ran elections in the U.S., I can tell you, they are not going to be happy, and they're going to, as already, start to question exactly what he's up to. I mean, you look at stalwarts like our senator from Texas, he's already called and said these tariffs aren't the right way to go.
So, Einar, what does Beijing do next? If they are digging in their heels, they have not reciprocated necessarily on the additional 50% that Trump threw out there earlier this week. They did, of course, retaliate late last week. Are they going to use all the arrows in their quiver, or many of them now, faced with 104% tariffs, or are they in the long game here?
Well, they're in the long game, but their quiver is far from empty or even shot. I mean, they have a lot more control over the economy. It's a planned economy. They have the ability to infuse into banks, to encourage companies to, as we have seen, do stock buybacks. They have a lot more control than the U.S. does. And if you're betting about somebody who's in control versus out of control, I think it's quite clear that Asia thinks, but expect more shocks. Beijing is going to come back with a retaliation. They have a point of doing measure for measure. It's not going to be pretty. But as I said, 2 months from now, Donald Trump doesn't really have a choice. It's either he backs down or the Republicans in Congress will join Democrats in backing him down.
In 2 hours, 50 minutes time, when the tariffs take effect, do you expect Beijing to come out, either Ministry of Commerce or others, with direct retaliation?
Yes. I mean, they've been waiting for a phone call or some sort of back channel communication saying, look, this has gone far enough. Let's figure out a face-saving way that we can get back together. And if not friends, at least be rational. What Donald Trump is doing isn't rational. He's simply trying to craft the world around the U.S., whereas China is saying, look, we have to live within the world. So two very different points of view. Donald Trump is afraid of looking weak. And at some point, though, he's not going to have much choice. Expect him saying, well, I taught the world a lesson. They know that I'm serious, and then he'll back down.
What happens, though, if this starts to have a bearing on social stability within China? Because we're already getting a lot of economics or economists coming through with projections on how much of a dent that these tariffs are going to have on the Chinese economy. You've as well got countries in this region, Europe, that might be wary of China exporting overcapacity, concerns around the employment outlook as well in China. What happens if the everyday person actually starts to feel the burden of these tariffs from the U.S.?
Well, they are going to feel the burdens, but they're not going to be blaming the central government. They're going to be blaming the U.S. government. China has a long history, 100 years of humiliation. It's something that they remember quite clearly, and I don't mean just, old people. They are determined in the face of any kind of bullying like this, they pull together. So actually what Washington is doing is coalescing the Chinese people around their government, far from separating it. And later on, as these shocks, if it continues, and I don't think it will, because, as I said, this is about the U.S. consumers, not the Chinese consumers in the end. They will feel the pinch. But as I said, they've been through hardship. The whole economy is only 45 years old. Prior to that, things were pretty grim at different points in time, but they pulled together and they went through. So this idea that China is on the brink of collapse is, once again, another fallacy.
Einar, great to have your comments this morning. Thanks for joining the China Show, Senior Fellow at the Taihe Institute in Beijing. Still ahead on the China Show, CICC Research joins us next to talk market strategy and why they see the potential risk of a liquidity shock amid the tariff volatility. And we're counting down to the open of trade in Shanghai, Shenzhen, and Hong Kong. As I always said all week, buckle up. This is the China Show.
And we're back this morning with the yuan reference rate. The fix just coming through again below that key threshold of 720, so 720.66 per US dollar. The estimate had been for 733.87. So really it could be the start of what's a very carefully managed and orderly, maybe only a gradual, but certainly some sort of depreciation. And it is the efforts of a policy response to, of course, these tariffs, 104% duties on Chinese exports to the US that are set to take effect in less than 3 hours from now. So taking a look there, you can see the Chinese yuan, the offshore one, reacting against this fixing this morning. But let's get to the equity picture now. Bring in Kevin Liu. He's Chief Offshore China and Overseas Strategist at CICC Research. And Kevin, thanks so much for joining us this morning. First interview as well with Bloomberg Television. But the Chinese markets, I mean, we've certainly seen some level of state support coming through so far. But what's your reading on where we trend over the next couple of days?
Well, in order to better understand the impacts of the tariff, we have to first understand where we stand right now. The tariff actually have multiple impacts. It's a kind of a surprise for everyone, but it's kind of a cost for everyone as well. It's a impact for U.S. from the supply side, so it causes impacts on inflation, eventually on growth. But it also gonna provides the shocks for demand side for the rest of the world, including China. So talking about the equity markets, a tariff will have several channels. First, it will impact the sentiments, the risk appetite, as we can see from the past few days volatility of the markets. So that is why it's essential for the regulator to step in to stabilize the market. Otherwise, it's going to cause a liquidity issue. If we look at back the historical experience, right now what the market price in, measured by the equity risk premium, is almost the same as end of 2018. So by saying that, just measuring by risk appetite, the risk reward is marginally increasing, but it hasn't priced in the potential earnings impact. The earnings impact, it will depend first how the tariff goes, and secondly, how the policy reaction. We do think it's going to cause certain impacts, especially on exporters. But if the policy can step in to provide more supports, they're going to, marginally ease the pressure on the markets.
What's your overall strategy to clients, though? Buy the dips. Are you confident enough to say buy the dips because of the national team coming in and also policy support?
Well, as I said, at this level, the expectation is almost the same risk appetite as the end of 2018. So at this level, without potential future escalation and downgrade in earnings, the risk appetite and risk reward is increasing. The national team, Central Beijing, step in to provide confidence is essential to avoid potential liquidity shock, which kind of important for every market. So at this point of time, if investor evaluate the market volatility and potential, given what the policy will step in to provide more supports, I do think provides certain good entry point. But we're going to see, it's really hard to provide a precise index target given this liquidity and sentiment-driven kind of market. Is all about holding cost and positioning for every investors.
Okay, difficult maybe to give the index targets, but yesterday we had Dan Wang from Eurasia Group, and she was saying that Chinese equities would outperform US ones this year. What's your view on that?
Well, let's take a step back. As the market, look at the market and the economy before the sudden shock of the tariff. Since the end of 2014, the market actually, has a really good run thanks to earnings upward revision. And also, the Chinese economy shows signs of stabilization and even upward revision in property sector and consumption. And secondly, we have the breakthrough of AI technology to provide new narrative and a potential growth engine of technology. So that's why, people's thinking and the narrative on Chinese equity is getting better. But still, before the new engine can provide more supports to offset the traditional part of the economy, exports still accounts for 20% of the overall economy. So near-term external disturbance is sort of inevitable, but let's focus still on structural technology and domestic demands.
Well, that's what I was going to ask you as well. I mean, does it have to be, as far as stock picking, is it sector specific, the ones that are not necessarily exposed to the export shocks that are coming, or is it particular strong state-linked names?
Our strategy is that the key focus, the key theme is still about technology over the medium term. Because we see, the breakthrough of the AI provides the potential more capital expenditure and even to drive the total productivity of the Chinese economy. But in the near term, before this sudden shock of tariff, its risk appetite, its expectation is a little bit high. That is why we actually suggest to partially profit taking around end of February, around the level 23,000 to 24,000 for Hang Seng Index. Now, giving the the digest of the external shock, the liquidity, whatever, kind of a multiple contraction, its attractiveness increase again. So still focus on technology. But during the volatility, we can shift to high dividend, to park our cash, and then shift it back. Domestic consumption still needs for more policy support.
All right, we might get more on the policy support then in just a few minutes from now, but that's Kevin Liu. He's staying with us, Managing Director and Chief Offshore China and Overseas Strategist at CICC Research, and counting down as well to the start of trade. And well, it's not looking good. I mean, we can already see that being indicated here. The Hang Seng pre-market trading already off more than 3%, but certainly we had that bounce yesterday. It's giving up again this morning, even though you've had state-backed investors, companies, regulators taking a lot of measures to try and stabilize the market.
Got to have a cast iron stomach to go bottom fishing still at this time, right? So we'll see. We'll see what kind of, if there's a bear market bounce, doesn't look like it at all.
All right, we'll have plenty more ahead with the market opening in just a few minutes from now. Tariffs as well taking effect in just over 2 hours from now. We'll have plenty more ahead. This is Bloomberg. We are less than 5 minutes away now from the start of trading in mainland China and Hong Kong. Taking a look at how the pre-market session is faring, as you can see there, US tariffs taking effect in just over 2 hours' time from now. So you've got the Hang Seng there, HS Tech. I mean, everything is looking for another day of selling pressure. Really tracks as well what we had in the Golden Dragon Index overnight, even though we've had some pretty coordinated responses from policymakers, investors to try and stabilise the markets as well. But let's change on, take a look at some of the stocks in particular that we're tracking this morning. CK Hutchinson has just erased all of the gains since the Panama Ports deal. Of course, it's not a deal that's exactly inked just yet, but what we know, of course, is that CK Hutchinson, that's a company founded by Hong Kong's Li Ka-shing, is under pressure to give up control of 2 of the Panama ports. It had moved toward a deal to sell its operations to BlackRock or a BlackRock-led consortium. There's pressure from Beijing to not do just that, but we'll leave that there as we can see the share price reaction. Oil stocks as well, given we've seen oil falling to a 4-year low. Again, all of these tariff fears are continuing to be felt through the markets. You're watching The China Show. We'll have the open ahead just next. This is Bloomberg.
And welcome back. You're watching The China Show. We are counting down, of course, to the open of markets in Hong Kong and in China. Belle?
Yes, Steve. I mean, yesterday was really that story of perhaps a bear market bounce, but we did see some stabilisation. Today, you can see there very clearly in futures. We're already guiding for weakness. Really tracks, of course, the sentiment that's coming across the Asian complex this morning, tracking as well what we had overnight on Wall Street. But it's that very big countdown now to these US tariffs, of course, on Chinese exports and others taking effect in just a couple of hours. So, taking a look, of course, what we can expect mainland China just a few seconds away from opening. As we said, futures had been guiding to some weakness in the session today. Really as well looking for any sort of further support that we get from the national team, essentially, that was very active in the session yesterday. But the CSI 300 has just come online this morning, already more than 1% to the downside. Tracking, of course, the offshore yuan very closely, given we just had the yuan fix. Onshore as well, one to note, we saw that really reacting quite significantly yesterday, given the fix was set above 720. We saw that again in the morning session. China yields, of course, one to track. We're continuing to see that retreat back down really to record lows, and commodities as well to note. I mean, take a look at that very sharp drop there you're seeing for Shanghai crude, off nearly 7% right now, but you do have global benchmarks as well off down to 4-year lows. So again, these tariff fears are still continuing to be felt. Let's change on, take a look at the Hong Kong session so far. What we're seeing, big focus, again, as you can expect, on the tech index here. off 5% right now. This is a full picture of red here, so it really tells again that picture of risk aversion. Alibaba, for instance, nearly 6% to the downside, standing out perhaps as one of the biggest laggards so far in the session. Switching now to take a look at some of these CSI 300 ETFs. As we said yesterday in the session, the national team really stepping in. I mean, I think their turnover, they're accounting for a 6.5% on Tuesday. You take that back to what the record is, around 7.4%. So again, it just tells you how much policymakers are really taking steps now to try and boost sentiment in mainland and Hong Kong equities.
Yeah, and Annabelle, behind all of this is what we saw with the PBOC and the weakening the currency for a fifth consecutive day, obviously in light of these tariff responses from the United States. As we count down to those U.S. duties taking effect in a few hours, let's bring in Bloomberg Emerging Markets macro strategist Marcus Wong. So, Marcus, thanks for joining us. How are you seeing the market's likelihood of a significant devaluation of the yuan?
I think that's really the question on everyone's mind. I think this question really started to, I guess, emerge, as a big question, especially with these huge tariffs that we're seeing. It's fair to say, I think the mainstream view right now is that PBOC will continue to weaken the yuan for 5 straight days. I don't think that it's rather a mainstream view that there'll be a huge significant devaluation. But there's definitely left-tail voices that we are hearing. Some even calling between 20 to 30% decline in the onshore yuan, basically to mitigate the impact of U.S. tariffs on China. Of course, the PBOC has a tight balancing act, in the sense that if they weaken the yuan significantly, this will actually quickly and promptly mitigate the impact of U.S. tariffs. But of course, the downside that they have to really weigh against is the impact on its financial markets, the outflows that could arise as a result of it. So again, I think it's very, very mainstream view right now that yuan will weaken, but it's really the next few days will be very pivotal to see whether we could actually see a very significant devaluation in the yuan.
And it's not just, of course, a dollar yuan story. There's also the trade weighted basket as well. So if China does go ahead with this, how is it going to be being felt across the Asian currency complex?
Yeah, I think the yuan is seen as a regional anchor for a lot of the currencies in the region. So we could see, for example, the Singapore dollar, the Taiwan dollar, the Korean won, and the baht being seeing pressure as a result. China is a major exporter, a trading partner to these economies. So undoubtedly, the Asian complex will be very badly hit as a result. I think it's interesting to note, I think, when the reciprocal tariffs was first announced last week, Asian currencies weren't sold off as badly as expected. But I think, moving forward, that if we see a significant devaluation in the yen, this will have really huge ripple effects across the region. On the flip side, I think currencies such as the Philippine peso, Indian rupee, will probably be more insulated because these are more seen as more domestic demand economies.
That was our Bloomberg Emerging Markets macro strategist Marcus Wong there. And still with us, of course, is Kevin Liu, Managing Director and Chief Offshore China and Overseas Strategist at CICC Research. And Kevin, we just heard Marcus talking there about the impact that policymakers will need to weigh up if they do allow devaluation of the Chinese currency. They will also have to consider those second-order impacts, including to stock markets as well. So how are you sort of assessing it right now?
Well, I think there are several kind of choices for policy to react to the potential external tariff impact. The first, I think more important policy choices is to provide supports for demand, because tariff is kind of a supply shock for United States. It's a shock for demand for the rest of the world, including China. By doing the currency devaluation to hedge against the tariff, I don't think it's a good strategy at this point of time, because there's a lot of moving parts and uncertainties, and it will also cause, as you said, the potential misconception and volatility in the markets. So rather, if we could expect more policy supports, for example, to provide more domestic demand consumption supports, to protect, to promote the demand, is going to be a better way. And also, you're going to provide supports for the consumption sector.
What would you say are the key risks to the market, though, and key risks to that assumption that the policy support and the national team are going to be there to prop up the markets?
Well, there are actually, I think, policy puts since early 2024, if we look at the market pattern, every time the market rebounds, although it overshoot and pull back a little bit, but the bottoms are always higher. Early 2024, May 2024, September 2024, and this time. It means policy actually step in, but there always kind of a lag between what the market reacts, just like today, and then policy reaction. And when people and market realize it will actually work. So I do think policy will step in to provide supports either on the capital market, to provide supports on confidence and liquidity, and also supports on the consumption. So we'll wait and see next couple of weeks to see more physical expenditure and more supports. I will call it invest in people and invest in future. Invest in people is highlighted in government work report, meaning that we invest in people to promote consumption. Invest in future is technology.
Yeah, so there's sort of the fiscal and the monetary levers, and given we're already in an easing cycle or easing bias in China, they don't really have the power there, so we can expect more of the fiscal support. And you're mentioning there maybe some support for companies, etc. But how much of an impact do you think we're going to see for these tariffs on company earnings, and how essentially CEOs are going to be managing these risks?
Right. Apparently, those exporters going to have greater exposure, for example, home appliance, electronic equipment, etc. But overall, for the earnings, a preliminary estimates before this tariff, we see upward revision. For Hong Kong companies, for example, we expect 4 to 5% earnings year-over-year growth for 2025. If we only consider tariff impacts without considering any policy supports or other moving parts, it's going to cause 5 to 6 percentage point drag of the earnings to the slightly negative territory. But again, it depends highly on how policy reacts.
What do your fund flows tell you about foreign participation in the market? It's less than it was in 2018, 2019. There's been a lot of pullback. What are you seeing right now?
First of all, we still see southbound inflows quite strong, meaning mainland investors are still very strong, interest in Hong Kong market, in H-share, in technology. But for foreign funds, during this rally, we do see inflow of trading money, hedge funds. We do see inflow from the long-only funds, regional money, regional Asia-Pacific, Asia region money, but not for, European and US-based long-only funds. I think this kind of a supply tariff shock probably will delay the return of the long-only funds from the United States or European-based investor due to uncertainties. So it's more driven still by many investors, flows and regional money.
Going back to sort of a shorter-term horizon now, how much volatility and how much further can we see Chinese markets slide from here in the near term?
It's very hard to give a precise estimate of the index, particularly driven by sentiments, driven by surprise of the news coming. We don't know, probably nobody knows where it goes regarding the tariff. So this is caused a lot of uncertainties. But again, I think it's important for everyone, every investor, the holding cost and the position. What I can tell is at this level, again, the risk premium, risk appetite pricing is already high than end of 2018. Maybe there are some reaction, overreaction, but at this point of time, with policy supports, the risk reward is actually increasing. Remember, previously, a lot of investors missed the rally driven by AI. So there are someone want to buy on dips, but it's hard to pick the exact bottom driven by liquidity.
Because we don't have an end in sight to this tariff turmoil.
Yeah.
All right. Well, but you're still seeing opportunities, I guess. That's that's the sense we're getting. Kevin Liu, thanks so much for joining us. Great to have you in studio this morning. That was the Managing Director and Chief Offshore China and Overseas Strategist at CICC Research. Quick check on markets as well, because we're 10 minutes into the session, and you can see it there, really. Further risk off today. Yesterday, as we said, slight move higher, lots of stabilisation, lots of national support. Today, though, again, early days, but we are in negative territory. Also taking a look at trading volumes, we're very elevated right now. Mainland, actually, we're a bit off the 20-day moving average for Hong Kong so far.
2 hours, 20 minutes until supposedly those additional tariffs from the United States are taking effect just after midnight Eastern Standard Time. And you can also turn to your Bloomberg for more on all of this. Go to TLive Go to get commentary and analysis from Bloomberg's expert editors. Plenty more ahead. This is The China Show, and this is Bloomberg.
The global trading system is under intense strain, more so than at any point in recent memory. We are witnessing the fraying of the global order. Therefore, ASEAN must rely more on itself.
That was the Malaysian Prime Minister Anwar Ibrahim speaking at the ASEAN's investment conference in Kuala Lumpur earlier, and taking as well a look at how markets are faring so far, because we did actually have Malaysia's stocks opening at the top of the hour, and again another day in negative territory this morning. Again, as we said, have been saying, really just tracking the broader sentiment that we have in Asian equities this morning. Lots of downside pressure as we continue to keep track and wait for these US tariffs to kick in essentially in just over 2 hours from now. But in the meantime, we've actually had an interview with Malaysia's central bank governor, and he says that forecasting growth is going to be difficult until there's certainty around President Trump's trade war. Abdul Rasheed Ghaffour told us exclusively that policymakers were taken by surprise by the scale of US tariffs.
When we came up with the projection of between 4.5 to 5.5%, we have factored in some conservatism in it, in terms of what could happen from this tariff and what could happen to global growth. But having said that, I think looking at the announcements during the Liberation Day, I think it has gone beyond what we have factored in. I have to acknowledge that. And not just in the case of Malaysia, even globally, everybody was caught by surprise in terms of the extent of the tariff that was announced. And certainly, we are reviewing the forecast range for this year. But again, we're not in a rush to change it for now, because things are still very much fluid. You see announcements being made from day to day, tariffs going up from 40, 50, 60, and now the latest 104%. And we need to see what could be the landing points. So once we have some certainty in terms of where would the tariff end up and how would the negotiations work, then we'll have a clarity in terms of how do we then do a better forecast.
Realistically, do you think it's going to be maybe just below 5% then? Or might we also be accounting for what has been a lot worse in terms of tariff announcements than anybody was expecting? So does the metric then kind of shift to below 4.5%? Is there a probability of that?
Well, it's not so much in terms of targeting a level that we want to see achieved. But for us, what we've seen in the past between 4 to 5% is something that's very good. That's something that is commendable. That's something that's a good growth for the economy. But again, it depends where we land. At this point of time, it's quite difficult to really tell whether it's going to be above 5 or below 5. But what the range has captured is that the baseline, based on what we know. And of course, there are upside risks and also downside risks to the baseline forecast that we have.
If it's depending on, all these unknowns, what are some of these scenario plannings that you'll have? Say, if Malaysia is hit by 20% plus tariffs, what is that going to mean for the hit to growth? 10% plus tariffs, maybe, if negotiations are successful, or even zero. What is that going to mean for the hit to growth?
Right. Of course, it could have an impact on growth. Again, it's difficult to say where it would end up, because if that happens, there are policy tools that we have in place to also deploy that will help mitigate the impact. So all these factors will play in terms of what's the announcement, what's the final tariff level that we have, that we face, and how does the negotiation works, and finally, what are the tools that we have to mitigate its potential impact.
Okay.
Yeah. For example, like export. Export will definitely be affected. And what's important to note is that in the case of Malaysia, our economy is diversified. Services sector accounts for 60% of the GDP. So services is not affected by the tariff. So the engine of growth will continue to be there. And second is that in terms of what are the potential policy tools that we can put in place to mitigate the impact, if at all the tariff rate is higher than what we expected. But if negotiations work and it came lower, that would be a plus point. And that's where the upside risk comes in, and it could result in a higher level of growth.
You talk about some of these policy tools. We have markets implying in the next 6 months a 25 basis point rate cut. If you stretch the horizon out further, 12 months, 50 basis points. How are you viewing this? What can we realistically be expecting?
Okay, interesting point that you raised about monetary policy. I think one point I'd like to share is that monetary policy cannot resolve trade wars. It's not the best tools to do it. But having said that, when we talk about the policy rate, what's important for us in terms of what's the mandate that we want? We want to achieve price stability that provides sustainable economic growth to the country. And when we do monetary policy, what we look at is domestic considerations. What's the best policy rate for the country in terms of achieving price stability and sustainable growth for the country?
And that's Bank Negara Malaysia Governor Abdul Rasheed Ghaffour speaking exclusively to our very own Bloomberg's Avril Hong. If you're a Bloomberg subscriber, you can catch up with all the interviews by using our interactive function. That is TV Go. You can also join the conversation by sending instant messages to our team and our guests during our live shows. Be kind to us. It's been a busy week. Check it out at TV Go. This is Bloomberg. Plenty more ahead.
If Trump weren't there, if we had a sane person as president of the United States, that sane person would be taking a very hard line on China, because the Chinese are in fact not good. They're not team players in the world economy. And the Chinese are still trying to do that, which is insane, because it's the United States clearly, is not going to be a market, and the Europeans, the rest of the world is not going to take their stuff either.
I think that depends on the Chinese. And, my advice to them would be that they have a lot more to lose than America does, that America holds the leverage, and everybody knows that, and therefore they should seek a détente, and they should offer concessions which would persuade the president to relent.
That was the White House economic advisor Stephen Moran and Nobel economics laureate Paul Krugman with their outlooks for China-US trade relations, and taking a look at how markets are faring this morning, 20 minutes into the session so far. And of course, we're also tracking what's happening in Japan, Korea, other major markets, because these are some of the pharma stocks that are falling very substantially this morning. So President Trump has been speaking about possibly more tariffs to come, and these could be applied to pharmaceuticals, what he says, very shortly. And so, of course, we're seeing quite a negative market reaction for some of these names. But ones like CSL in Australia, they get 50% of their revenue from the US.
That was just one thing he said in a very long speech at the Republican meeting there. He says, I know what I'm doing on tariffs, by the way. Now is our time to do the ripping, as he was talking about trading partners ripping off the United States. He says these tariffs will be legendary. We're actually being nice on tariffs. And he had a number of comments about China, which we probably need to go into, because we're essentially waiting as well, not only for in 2 hours, 8 minutes when those tariffs hit, the additional tariffs, reciprocal tariffs, and also that additional 50% on top of China's tariffs. You see a potential another round of retaliation from the Chinese, possibly from the Ministry of Commerce. But he's saying China badly wants to make a deal. We are waiting for their call.
Yeah, and actually on China, because we've seen as well the defences and the different mechanisms that are being used to try and shore up sentiment there. And one of the approaches, and I guess taking advantage of the selling activity, has been the amount of buybacks that Chinese companies have announced as well. So we can take a look at some of these names still in the red here, but Costco Shipping, for instance, Postal Savings Bank of China, the Aluminium Corporation, of China, just some of the names that have announced buybacks so far. But yes, going back to President Trump's tone earlier when he was speaking really defiant and brushing off any of the concerns that investors may have about his approach to levies. But taking a look at broad China benchmarks as well, because just under 25 minutes into the session today, and again, still seeing that downside pressure so far.
Yeah, and then we haven't really mentioned too much, and we will talk about it in the next hour, about what some are saying is, maybe the beginnings of a little bit of infighting within the White House, with Peter Navarro saying that Elon Musk doesn't understand tariffs, and Elon Musk firing back on X as well, calling him a few names. Shall we repeat them?
Please, go ahead.
This is dumber than a sack of bricks, and also truly a moron, are some of the comments that Elon Musk is saying about Peter Navarro. So, again, maybe some cracks developing behind the scenes in the White House.
Yeah, certainly a signal at least, and the way that the White House is also interpreting this is just saying essentially President Trump is listening to a variety of different perspectives, but certainly Elon Musk does seem to be taking offence at being called a car assembler, not a car manufacturer, but a car assembler, and also making the point as well that he does manufacture vehicles for the US market in the US, and also does source a lot of parts domestically as well. Just a note, coming up in the next hour, we are going to have the RBNZ decision shortly. Really be watching. 25 basis points is expected, that move. If we get 50, again, it could be an indication that there's tariffs already being felt. But Johanna, she's joining us from Citigroup as well to talk about the impact to economics or economies, and we'll have more details on that ahead. This is Bloomberg.
They don't want tariffs on themselves. And it's very simple. We're making deals, and people are paying tariffs. Countries are paying tariffs. Right now, China's paying a 104% tariff. Think of it, 104%.
I want to stress once again that trade and tariff wars have no winners, and protectionism has no future. Chinese people don't make trouble and are not afraid of trouble. Pressure, threat, or blackmail is not a right way to engage with China, and China will take necessary measures to firmly safeguard its legitimate and lawful rights and interests. If the U.S. disregards interests of both countries and the international community and insists on a tariff war or trade war, China will fight till the end.
As China's foreign ministry spokesperson and President Trump speaking about tariffs, and as you can see here, US tariffs taking effect now in 2 hours' time. Markets are really on edge about this, and we've seen very, very volatile trading across the course of this week. But today, again, further pressure coming through, and you're seeing the Hang Seng there under 2% as we get trading starting here. Just to mention as well, we just had the RBNZ decision coming out, and they've cut by 25 basis points, so that was what had been expected. Of course, there was an outside risk of 50 basis points, and you're certainly getting these calls coming through. Maybe we do need to see central banks hastening their easing cycles, but you've seen there 25 basis points, so it comes in at 3.5%. Kiwi dollar, I mean, you're already at 55 cents, and we haven't seen that level going back to the COVID era, essentially. Broadly now, let's take a quick look at how markets are faring this morning, and as we said, it's risk off well and truly. Today we've got the broader gauge down 1%. What is leading the losses so far is the Nikkei 225. Again, very big swings here, because yesterday we're up 5, Monday we were down 5, today 2.5%. Tracking as well what's happening with Treasury yields, because we have seen very big moves across the curve. Lots of concerns being felt now about really the haven status, essentially, of US government debt, and how the Fed is going to be managing as well the certain dynamics. They are really still, at least publicly, pushing the case for more data first. JGBs as well to track, because we've just seen them as well rising for a second straight session here. Again, it is all these concerns that really reflecting what we see in the Treasuries market as well.
Sure. So market participants on tenterhooks a little bit as we approach that deadline in 2 hours. We know what's coming. because there's been no indication that Donald Trump is backing off from his threat of adding another additional 50% on top of the 34% on China. He's talking about tailored deals with others, perhaps South Korea, possibly Japan, but still, Liberation Day was just a week ago, and now it's not given a lot of the trade partners with the United States much time to deal with this eventuality that is about to hit the market in about 2 hours' time. Let's bring in Johanna, Chua, head of emerging market economics at Citigroup Global Markets.
Hello.
Good morning.
Good morning. I'm not sure it's very good.
Right. So I saw your note from Citi basically revising some of your global growth outlooks. Have you been continually revising as we sort of headline surf the news and the outflow of tariff threats?
No, absolutely. I mean, there's so much uncertainty now. I mean, clearly the uncertainty shock is already putting downside pressure on the U.S. economy itself. And as you know, East Asia is very exposed to the U.S. economy. But then we have this massive asymmetry in the tariff incidence of the reciprocal tariff. Of course, China's getting the brunt of it, especially if you get the stacking 54 plus an extra 50. But it's ripping across factory Asia. You've got a number of Southeast Asian economies, even some that are relatively low middle income economies that are going to get tariffs in the order of 49% for Cambodia, 46% for Vietnam. These are very, very punitive. And I think it's really going to create a lot of downside pressure. We've been doing a lot of macro simulation of what this kind of asymmetry and growth shock in the U.S. could look like, assuming this tariff is a permanent shock. And you get orders of magnitude of crisis level growth shocks in countries like Vietnam, which we think will also be similar to Cambodia. And then you got also a big pressure on ASEAN, in some ASEAN markets. So this is quite big. And I think what is really shocking to me, and this is why I was so shocked with the reciprocal tariff, it's not even clear what the strategic objective is of kind of reshoring jobs in America when you've got manufacturing wages in Vietnam that, according to 2024 JETRO surveys, only 7.6% of manufacturing wages in the U.S. So there's really such large disparity on labor cost differential. This is not going to go back to the U.S. So why are you kind of deliberately imposing such disproportionately economic hardship? Again, for what? And then maybe it's all about a deal, but I think the big question now for a lot of people is, what deal exactly are you looking at? I mean, you've got Taiwan, Vietnam, they've all conceded very quickly to bring tariffs of goods to U.S. down to zero. And now Peter Navarro says, well, it's not just tariff, it's also non-tariff. And then you just kind of pile on what exactly are the conditions. So it's good that we're hearing some talk of deal, but the problem is we don't even know what are the parameters
for this deal. Well, he says it's going further. Peter Navarro says it's even going to go further than this.
Yeah, so going back then, I guess, because it's very difficult to understand to what extent and where we're exactly washed up with the tariffs. But when you say about the sort of orders of magnitude, what kind of hit are you expecting across Southeast Asia?
So right now, I mean, again, we're taking it a step at a time because, again, there's always a little bit of a hope that some of these reciprocal tariffs are going to get rolled back, even though we're going to assume a baseline of 10%. But we've already hinted, for example, for Vietnam, originally prior to all this tariff, we had a growth forecast of about 6.4%. We may have to take it down to 5%. That's 140 basis points hit. And of course, if this extends to 2026, you even have more lagged effects of more damage. In China, we just downgraded our growth forecast by about 50 basis points this year. Going, and then we also downgraded growth forecasts, in 2 steps in Korea by about 40 basis points. We downgraded, India 30 basis points. But to be fair, I mean, there's so much uncertainty, and I feel this is going to be a rolling exercise because we're going to be waiting as the data unfolds and what the U.S. is going to do. Are they going to roll back or not? And if nothing happens, I think we're going to have to even downgrade further, and we're going to have to change our view of how much monetary easing we're going to get and what that means for dollar Asia FX heading higher.
If I read you correctly, I think you're essentially saying the United States has given itself no escape plan from this. They're stuck to this because they also tariffed a lot of the alternative suppliers to China if they want to isolate China, as they did in the first trade war, Vietnam and other places. So that's going to have potentially, a lot of the pundits are saying, a recessionary impact on the United States.
Well, it's not,
with rising inflation, right?
Well, absolutely. So you have a stagflationary shock in the U.S. I think the big uncertainty is just there's so much uncertainty. Even if you want to reshore, do something, you don't know how to plan, and that's going to create a lot of caution. And there are no kind of alternative, cost, China plus one alternatives that is clear. Now, there are some economies in Asia that got less of a reprieve. I think what was interesting from this whole reciprocal tariff exercise is Mexico was not touched. And in a way, if more and more U.S.-Mexico trade is going into USMCA, then you have this arbitrage there. But again, it's not that this simple to just move a plant. We don't even know if there's capacity there. So there's a huge cost that entails, and that's why people are slashing dashing their expectation of corporate earnings in the U.S., etc. But I'm just saying that, Asia, we have the asymmetry of the shock. So some of the slowdown in Asia is maybe cyclical if we think, U.S. is slowing down and eventually we'll get some normality. But some of it could be structural if some of these tariffs are here to stay, which is really undermining structural competitiveness of this region. Now, some worse than others, and hopefully we'll get a better deal in, India, and, some markets didn't get much reciprocal tariffs like Philippines. So far, semiconductors are not tariffs, so the effective tariff rates on Malaysia is not so bad, and Singapore is 10. So you've got few pockets. But again, some of these economies are so exposed to the region, so there's definitely a lot of spillovers that we have to watch out for.
Yeah, and I think to the point you were making there about sort of the recessionary clouds that are building on the horizon, I mean, you can sort of see that as well being reflected in long-dated treasuries, because you're seeing, again, these moves, the yields that are jumping really across the board. But part of that also could be about the Fed not really being in a hurry to cut rates because of inflation. So you mentioned how you might need to rethink the prospects for monetary easing in Asia. How do you do that if the Fed is sort of, I'm not going to say dragging its feet, but they're more cautious as well?
Well, the size of the external fuel demand shock, I think, is very large. That in the end, central banks have to factor in both growth and inflation. And I really don't see, even prior to this April 2nd reciprocal tariff, most of Asia didn't really have much of an inflationary pressure anyway, not to mention commodity prices are coming off. So at this point, the worry now is kind of economies going knocked off below potential, and obviously inflation going below target. And why are you still having, ex-ante real rates that are above neutral? I think we should start questioning, should we even go below neutral at this point? So I think there's a number of central banks where there's more room to go. And I think that monetary easing, the FX depreciation is part of the transmission mechanism of that monetary easing. I think that is a story we need to watch out for.
Earlier, you rattled off a number of different economies that have gotten your downgrade. What about China? And they are playing the long game here. Yeah,
so look, I mean, obviously, they're obviously talking tough. And, I can certainly sympathize with the view that you don't even know how to negotiate. We don't even know what are the parameters of negotiation. So I guess they're kind of fighting tough. As a large economy, they've got a little bit more bandwidth to retaliate. I mean, small economies don't really have that same bandwidth. But don't get me wrong, China's going to get hit by this, because it's not just China. Last year, 30% of China's growth came from net exports. This global uncertainty is going to cause a global demand shock. That's going to impact net exports, not to mention you're shutting down some of your third-party rerouting. Hopefully, we'll get some more clarity of policy easing support, but again, I'm not really sure it's going to be big enough. So I think obviously in China, there's obviously a lot of posturing, but I think it's a big shock. And, it's not clear to me that if Trump raises another 50%, that's going to get China to concede. Again, I'm not sure, because there's a big question. If China's effective tariff rate is already 65 and it's already prohibitive, what's the marginal damage of adding another 50? I mean, 65 was already prohibitive already.
So what's the knock on GDP for the number that we have right now, 104?
So we haven't factored in the 104 yet. So we've just done the exercise. And again, a lot of this is you have to make some assumption of what the counter-cyclical policy response. But I guess, at the moment, I have to admit, even though we've downgraded by 50 basis points, based on the turmoil that we're seeing now, we have to factor in potential risk of further downside if this thing is not resolved anytime soon.
Yeah, actually, I think on that point, though, Goldman Sachs, for instance, is one that's saying at 50% tariff, you're going to diminish Chinese GDP by 1.5, and then it's sort of diminishing after that, because they're saying more leads to essentially less of an impact to GDP. But how exactly does China respond then? Because we've seen, lots of questions around how they might use the currency, for instance. They don't have as much power on the monetary side. So is it really that fiscal approach?
I think it's going to have to be more fiscal. If obviously we're starting to see, hopefully we'll get something out of the April Politburo meeting later this month. It's going to have to be more fiscal, more support for domestic demand. But again, I think we're going to have to see more easing on the liquidity front. A lot of SMEs could get hit by the shock that we're seeing in manufacturing. Not just in China, but even parts of Southeast Asia. So I do imagine you're going to get, just like during COVID, where you get kind of lending support or regulatory forbearance on lending of some SMEs. This could also happen in order to avert kind of more negative pain across the manufacturing space.
As Belle alluded to as well, what about the renminbi? How far do you think they'll let it go? Because we've seen 5 consecutive days now of a weaker fixing.
No, look, absolutely. I think in this type of shock, we should expect potentially a bigger move. Of course, they're trying to stabilize the move. They're not letting a disorderly adjustment. Like I said, I don't think the deliberate strategy is to use renminbi renminbi as the policy tool to combat the trade war. It's more like a byproduct of the fact that they need to provide more policy support in the economy, and then the renminbi has to adjust on the back of that. But I think they are sensitive that if you create too much volatility in renminbi, that will also ripple across the global trading environment, and that could exacerbate. I mean, there's already a lot of economies very worried about the trade diversion of cheap Chinese goods undermining their own economies. So you don't want a wave of protectionism to spread beyond U.S. to other economies, which is part of the reason why I think they're also kind of calibrated about allowing the severity of the renminbi.
There could be outflows, too, at a time when they need to shore up their domestic economy.
And so then again, you know, on that point of yuan depreciation, how does also China sort of manage that against its trading partners in Asia as well?
Yeah, no. Look, it's a very tough trade-off right now. I mean, obviously, I think it would be better to provide more domestic consumption support to help absorb some of this excess goods and prevent a lot of kind of deflationary spiral. That's what we're hoping for. But again, it's not really clear. They've already announced quite a bit. They're still saying there's more fiscal space. I think China can do more, but the problem is you don't know how long this trade war is going to go on. And if you have to preserve your bullets, do you fire everything right now, or you kind of trickle it over time? And again, I mean, that unfortunately, the shocks coming out of Washington is faster than the ability of policymakers to respond to it.
Yeah, certainly, I guess the Fast and the Furious comes to mind, but that was Johanna Chua there from Citigroup Global Markets. And again, on that point of all of these trade shocks as well, I mean, we've just heard from the RBNZ coming out with their decision. Yeah. They've cut for a fifth straight time, but 25 basis points. There was an outside chance they might go for 50, but essentially bringing that key rate down to 3.5%. They are signalling that there could actually be more to come again because global trade barriers are weakening the outlook for the global economic activity.
I think it was Mark Cranfield yesterday saying, you know, these kind of moves by central banks need to be considered across the board, across Asia.
And every decision, or every meeting rather, is going to be a live one as well.
Live one, every single meeting, absolutely. So New Zealand, it was your play there. All right, coming up, my bad, not my bad. Bill Ackman's bad. U.S. billionaire admits he didn't fully anticipate the market rout caused by Trump's tariffs. More next in today's Big Take on all the billionaires, what they're saying a couple of days ago, what they're saying today. Is there backtracking? Is there doubling down? This is Bloomberg.
Well, we are just a couple of hours now away from these tariffs taking effect, and it's certainly the subject of the Big Take today. But essentially, after a week or almost a week since we got these reciprocal tariffs as well being announced, markets, we know they're still volatile. Losses are continuing to mount, and now some prominent Wall Street figures are starting to sound a little bit nervous, Steve.
Yeah, it's very interesting to hear the different comments. On Sunday, Bill Ackman tweeted that he did not foresee the market rout, writing that I assumed economic rationality would be paramount. Bloomberg's Felipe Pacheco joins us in the studio now. How meaningful are all this chorus of comments from the billionaires, including from Bill Ackman, who kind of now saying, my bad, even though he came out with blistering criticism of the magnitude of the Trump tariffs?
That's right, Steve. I think it's extremely meaningful to see someone like Ackman, who is the face of Wall Street, who was, back in time, he was a very big Democrat supporter.
And changed
his mind along the way. It's you have stories that he actually became a pro-Republican supporter after he met Trump and he met Musk in a dinner in Washington. So then he became a big donor to the Republican Party and to the election of Trump. And now he's basically saying, as you mentioned, that he didn't foresee this coming. He didn't expect this to turn out this way. And I think that what we see in Wall Street right now is just a call for these billionaires, a bunch of the big names that were backing Trump initially from the very early moments of the campaign, realizing that this was not nearly as bad as they were expecting.
But Ackman flipped twice. So, right? So he was a Democrat, then became a pro-Trump Republican, then criticized Trump, and then now, again, a day later, saying, my bad, maybe I do believe in the tariffs, but I am in support of a pause.
Exactly, a pause that was expected for today, right? Because today is the day when the things were supposed to get a lot worse than many people expected. It's very hard to predict how far this change will go and if Ackman will actually come to X again and keep tweeting, because we've seen even a retraction over the past few days. He had a bit of conflict, let's say, with Lutnick, who is also a very big name from Wall Street. Cantor Fitzgerald had in the past a very, very big supporter who is part of the Trump government right now, and they were publicly going in different directions, let's say, when it comes to Trump's tariffs policy.
What about Jamie Dimon as well? Because he's, of course, someone else who's sort of been making his views clearer. He had his letter to shareholders. What was the sense that came through from that then?
Well, that's a very, very interesting name to bring up to this conversation as well, because, of course, J.P. Morgan, the voice of Wall Street, a very, very big name, and it's widely heard, not just in the U.S., but by all of the international financial community, right? He came to say that the tariffs might be disastrous in the long run, and in a way that even though America first is fine, this is his direct quotes, America first is fine as long as it doesn't end up being America alone. And this was in a letter to shareholders shared on Monday when the U.S. market was tumbling again after what we saw last week. So it's a U-turn in many ways by a lot of those names that were somehow linked to the policies that Trump had announced in the past that he would be bringing.
How much do you make of what has become sort of a war of words between Peter Navarro, sort of the architect of this tariff plan, and one of the key advisors to the White House, Elon Musk? They're using, well, Elon's been using some pretty sharp words.
It's even hard to separate all of the different fights that are somehow going on online.
Is it infighting, though?
It's absolutely. It's infighting. It's not coming from anywhere, but within the group of advisors and actually names that are extremely linked to Trump, right? For example, as you mentioned, Musk and Navarro over the past 2 days, he used some expressions such as Navarro is dumber than a sack of bricks. And right after that, he called him truly a moron. That's under his own quotes. And Navarro actually called Musk just an assembler of cars. He said that he was actually not a car manufacturer. And that seems to have infuriated Musk, who just published a bunch of other tweets trying to prove he was producing all of his Teslas in the U.S. with U.S. pieces. So the discussion has got to a point that it becomes very hard for us to know who is going to be backing the tariffs as they are right now, up to what level, until when, and what could be actually the next tweet once they all wake up in the U.S. Because what we've seen over the past 3 days is just, as you mentioned, just infight. But all kinds of different supporters, either to the White House or to the trade secretaries. Everything just seems to be crumbling in a quite fast pace.
Yeah, Navarro said Elon doesn't understand tariffs, and I think that goes for a lot of people, at least the way that's been put forward by the Trump administration over the last week. All right, that's Bloomberg's Felipe Pacheco. Thanks so much for joining us. And subscribers can read more on today's Big Take on the terminal and at Bloomberg.com.
And we're also just taking a look at Chinese markets have just actually had some very interesting moves, because we're seeing them now erasing those earlier losses. So the Hang Seng Tech Index, for instance, was down 6%. I mean, still you're seeing the broader Hang Seng a little bit under pressure.
Is the national team coming in?
That's the big question. I mean, we've seen them very active yesterday in the session, accounting for around 6.5% of overall turnover. But we'll have more details on that ahead. You're watching The China Show, and this is Bloomberg. Taking a look at some of the big movers in the session so far, as, again, we await these US tariffs taking effect in just over 90 minutes from now. One of the industries that's sort of been spared so far is pharma, but President Trump earlier today is saying that he's planning to announce major tariffs or duties on pharmaceuticals very shortly. And so you're seeing a lot of these names in Asia under pressure. These are the Chinese ones on the screen right now. Switching on to take a look at some of the seed stocks as well in China. This is a very different story, but essentially we had seen gains for some of these, now giving up those, but we have seen authorities approving 99 versions of genetically modified corn and soybeans. That's the ag story. Let's shift on now. Take a look at carbon fiber producers over in Japan. Again, these have been slumping today, and that's after we had the Nikkei reporting that essentially the EU is considering a ban on the materials use in motor vehicles. So we've seen, again, some of these names under pressure so far, but it is a very, very volatile market right now as we await these tariffs taking effect. Duties on China set to come in at 104% just in a couple of hours. More ahead. It's 11:29 a.m. in Tokyo. Japanese markets just about to go on to their lunch break, and you are seeing further downside pressure here today. Actually, Japanese equities are leading the losses on the benchmarks. It's very interesting commentary out on the MLive terminal this morning. They're saying Japanese stocks back in grizzly bear zone. So it's not just a bear market territory, it's a very angry bear right now that we're seeing in Japan. Yes, Tokyo is expected to get priority in the US tariff talks, but I mean, how much do investors care about that when you've got globally, pretty much meltdown mode? What is interesting though as well, speak about meltdown, actually there's not I'm not going to say a melt up, but we are seeing certainly signs of stabilization in Chinese equities that have managed to reverse their earlier losses today in the mainland and now are actually starting to trade positive. If you take a look here, you can see the CSI 300, for instance, fairly flat, but certainly Star 50, for instance, standing out today.
Yeah, that's right. Let's bring in our senior Asia equities reporter, Abhishek Vishnoi. So does this sniff of the national team kind of jumping in and putting a floor and a little bit of helium, if you will, into the markets?
That's right. There is some speculation of, why this kind of recovery has happened. CSI was down earlier in the morning, down by more than 1.5%. It turned into a positive zone, just a few minutes ago. HSAI also curtailed its losses to 0.5%. It was down about 4.4%. So there is some speculation around it that possibly national team is intervening in the market. And then, the underlying forces of possibly front-loading of stimulus, like we have been reporting, the afterglow of DeepSeek-led advancements in AI. But it looks like some institutional hands are coming to the fore. If you look at the kind of moves that we are seeing in tech stocks, the kind of move we are seeing in straight-run enterprises, the two areas that some of the China-backed funds have flagged over the last 2 days that the way they are interested in. But, this move sort of coincided with a similar sort of, recovery in U.S. futures as well. So that sort of muddies the picture a little bit. The reporting on it on this aspect is yet to flow in, but there is some recovery underway. And it's sort of China, it sort of started with Korea. Korea was at the brink of entering into a technical bear market, was down about 1%, but Kospi retraced those losses, most of them. And then we saw similar moves happening in CSI, HSCI. But it coincided with the U.S. future, so we are yet to establish as to whether this was like like some institutional hands coming in globally, or more to do with national team.
And Abhishek as well, we've got the Bloomberg intelligence team saying that when you take a look at pairwise correlations, it does indicate to them at least that some markets have just fallen too far, too fast, and China is one of the names that stands out. So do you think that there's even a potential that we continue to see at least stabilization? Is it even possible of moves higher? I mean, that just sounds a little bit far-fetched when you've got tariffs taking effect in 90 minutes.
Well, not a very sharp rebound, but definitely there is a case, like you pointed out, not just BI, but a lot of strategists are pointing out to this, that valuations in a lot of markets are near recession trough levels, except maybe in case of India. So the downside may be limited in those areas. And while China is facing a lot of tariffs, the policymakers are very confident that they can front load stimulus and possibly negate the impact of these 100% odd tariffs that Trump is about to impose. So there is a case for that. But look, US is the mother of all markets, the mother of all economies by the sheer size of it. So there won't be any economy or market which will remain unscathed because of this. Yes, it may happen that markets like China, Australia, they may grind sidewards or outperform just by falling less. But there is no significant green on the screen that we're expecting right now.
All right, Bloomberg's Abhishek Vishnoi in Singapore. Thanks for joining us and giving us an update on the markets this morning. Well, Southeast Asian central bankers and finance ministers are meeting in Kuala Lumpur as part of this year's ASEAN Investment Conference. Malaysia is currently the chair of the bloc and has been calling for a unified response to those U.S. tariffs. Bloomberg's Avril Hong is covering the conference for us in KL. So, Avril, clearly a lot of these Southeast Asian nations took the brunt of the Trump tariffs announced last week. Is there a unified response that you're seeing?
I mean, we've been discussing this for much of the past week, how that would look quite difficult given the varying rates of levies you got on the high end for the likes of Vietnam, Cambodia versus 10% for Singapore, right? So it's also this concern that it's not just about the levies that are going to be imposed on these Southeast Asian nations, Steve. It's also about how this would affect China. I mean, if we take things at face value, 104% on China, which is still, for many of these nations, one of their largest trading partners. How might this affect trade flows? I spoke exclusively to the governor of Malaysia's central bank. Let's take a listen.
We have a very diversified trade partners. We trade with the world. We trade with the US, we trade with China, we trade with the EU, and we trade with anyone else. And no countries represents more than 15% of our trade and export. So basically all are below 15%. So they're very well diversified. And having said that, not just in terms of countries, but also in terms of products, our export market is quite well diversified. So any issues or any problems that we see in one particular country or one particular product lines will not have a big impact on our export market. So that's why it's important for us to push for this diversification. It's something that we have done intentionally for the last 10, 20 years, and something that we'll continue to do so. And in fact, now I think we're even looking for new markets for us to deal with, to trade with.
So do you think, are you saying also that, potentially there will be enhancing of trade flows between Malaysia and China or not? What is your sense of how things are evolving?
It could be with any countries. What we want to do is to enhance trade, and we are looking for new opportunities, we are looking for new markets, and we are looking for opportunities to even enhance trade with any particular countries. Not necessarily with China alone, but any countries that can do business with us. More importantly, business in terms of trading, leveraging on fair trade rules, and leveraging in terms of win-win situation for both partners.
But if we take these tariff levels for China at face value, that could mean that it doesn't make sense for them to export to the US. Does that mean there's a higher risk potentially of, goods being dumped in Southeast Asia, including in Malaysia?
Perhaps maybe may not be able to provide much color or insights in terms of how China will react to the trade tariff on China. But at least what I can say from Malaysia's perspective, we will continue to trade with all countries. And we want to diversify further our partners. We want to diversify in terms of products as well. And we see great potential here. Given these developments that we saw, I'm sure many other countries are also looking for new partners. It's a win-win situation for everyone.
How closely are you watching the renminbi then? Because we know how Malaysia's ringgit and the yuan, there's still close correlation. It fell offshore renminbi to a record low just a day ago. How closely are you watching that?
Perhaps maybe this has changed. I think in the past we do see strong correlation, But it's not so much the case now because looking in terms of where we are, in terms of our trade partners, and in terms of the diversification of our trade and products, we don't see that as much correlation between any particular country. So that is why, again, Avril, I think it's important that we have these diversified trade partners and we don't rely on a particular country for the economic growth. So that has helped in terms of decoupling, in terms of movement of currency in other countries to the ringgit.
So it's still a message of diversity among trading partners. And he also went on to argue that Malaysia is entering this tariff war from a position of strength. You'll know that the Malaysian economy did really well last year. Now, as to the odds of a rate cut in the next 12 months or so, which swaps markets are pricing in, he said that the current rate of 3% is still supportive of growth. Belle?
Great interview there. That was Bloomberg's Avril Hong, and we'll have plenty more ahead as we count down to these tariffs taking effect. You're watching The China Show, and this is Bloomberg.
China has a long history, 100 years of humiliation. It's something that they remember quite clearly, and I don't mean just, old people. They're determined in the face of any kind of bullying like this, they pull together. So actually what Washington is doing is coalescing the Chinese people around their government, far from separating it. And later on, as these shocks, if it continues, and I don't think it will, because as I said, this is about the U.S. consumers, not the Chinese consumers in the end.
That's Beijing-based analyst Einar Tangen speaking earlier on The China Show. And we're counting down to the additional U.S. tariffs taking effect in less than 2 hours' time. Bloomberg opinion columnist Karishma Vaswani thinks Trump's trade war could drive Asian nations to strengthen cooperation with each other and with China. Karishma, great to see you. She joins us now. Now, you say that Asian countries will sort of drift towards Beijing. Give us your argument for that thesis.
Yeah, well, Steve, in the short term, I think what we are seeing, the reality that these Asian countries are facing right now is that they effectively have to kiss the ring, right? You've seen the likes of South Korea, Vietnam, all offering concessions to Trump, Japan also trying to make a trade deal there. And I think what that reflects is in the very immediate term, you have a sense of understandable panic in these countries around Asia and the Indo-Pacific because they are worried about the impact of these potentially disastrous tariffs on their economies and on their populations. I mean, I'm sure you've talked about this on the program before, just the degree to which globalization, free trade, all of that has helped lift millions of people out of poverty, lift living standards across the region. And there's a real concern out here that that could change. But I think longer term, what this is going to do is remind people in this part of the world, governments in this part of the world, that the United States under Donald Trump is not a predictable ally or partner. And that means they're going to start to realign themselves strategically far more with China. And let's not forget, Beijing is the biggest trading partner for a lot of the countries in this part of the world. So it's not that dramatic a shift in any case. But it is an opportunity that the U.S. is wasting out here, given the fact that so many Asian countries, particularly recently, have expressed regional disquiet over how China is behaving in the South China Sea.
Yeah, so I guess if you see sort of further strengthening of ties in amongst Asian nations, I mean, it definitely has consequences then for the U.S.
Yeah, it does. And I think what you will see is that, really hard to quantify aspect of soft power. The United States has always been the emblem, not just of democracy in this part of the world, but it's an aspirational place. It's a place where people want to send their children to university. It's the place that has been the architecture of that free trade environment that has helped to boost so many economies in this region. And it's basically saying to its partners in this part of the world that, look, you know what? we're going to head for a divorce and all the terms are on our terms, not yours. I think what this does is it creates a real sense of a lack of goodwill amongst Asian governments. We've heard comments, quite strong ones, I have to say, from the likes of Singapore's Prime Minister Lawrence Wong, who talked about the fact that these tariffs are akin to the kind that we've seen from the 1930s, which eventually led, in his words, to real conflict and the Second World War. And I think what you will see as a result, and you're already seeing this, as I argue in my column, is a lot of countries in this part of the world reevaluating their defense and strategic positions. They're going to start rearming themselves. We've already seen defense spending and defense budgets go up in this part of the world. And what that means is it's a more dangerous world for all of us.
Yeah, you alluded to the Smoot-Hawley tariffs back in 1930 that exacerbated, many say, the effects of the Great Depression, and then did, obviously, in 1939, was a prelude to World War II. But China has a long history of dealing with these kinds of disputes and taking the long game of what some say is a game of chicken. What should, or what do you feel will be Beijing's response? More measured or sharper?
Well, I can't speak for what might be going through Xi Jinping's mind right now, Steve, but, you know, it would not surprise me if people are advising him to sort of stand firm with the position that Beijing has been taking of late. And I was speaking with a Chinese academic yesterday, and what he said really struck me. He said, look, all that we want from the United States is some respect. We are the world's second largest economy, he said, and if the U.S. really wants to make a deal, then send a bunch of a delegation of U.S. officials to China and talk to Xi Jinping and some of the officials there. But China's not going to back down. At least that was his opinion. And that's certainly my sense as well. I don't think China will be the first to blink in this staring contest.
Right, that was our opinion columnist, Karishma Vaswani there. Thanks so much for your insights. And certainly it is that big theme of exactly how the US goes about unraveling the relationship, and it's very delicate, but it's certainly not being treated perhaps in the most delicate of ways. I mean, we had Vice President J.D. Vance, for instance, overnight calling some Chinese workers peasants. It's not exactly being very well received in mainland China. So taking a look at what's trending this morning on the mainland, and it is those J.D. Vance comments that are sort of front and centre for many. So let's get more with our Asia government and economy correspondent Rebecca Chung-Wilkins joining us. So, yeah, talk us through the backlash, basically.
Yeah, so these comments came originally from J.D. Vance, actually late last week, essentially saying, why are we borrowing, why is the US borrowing money to buy goods that are manufactured overseas? And he gave this very colourful and, you know, seemingly very disrespectful comment about Chinese peasants, borrowing money from Chinese peasants in order to buy what it is that they're manufacturing. And that has had quite a heated response from China, both from official sources. So we had the Ministry of Foreign Affairs commenting yesterday saying, you know, it's surprising and it's sad to see the Vice President showing this degree of a lack of respect and a lack of knowledge as well. And I think it underscores that point that, you know, Karishma Vaswani was pointing to, which is it's this whole issue of disrespect for China, that there is not the sort of sense that these are genuine partners who want to find, or even a counterpart, let's not even say partners, but a counterpart that wants to try and find a solution here. We've also seen these responses that are blowing up to J.D. Vance's comments on social media as well. Those remarks, the hashtag linked to that has been seen more than 140 million times. There's some irony that's discussed about of course, he wrote Hillbilly Elegy about rural, poor America. So there's an irony that people are pointing out, but also a lot of comments comparing the US to China, as you would imagine, saying we might be peasants, but we have one of the most sophisticated rail systems in the world. We have autonomous driving. We have leading drone technology, leading AI technology, and also, you know, making disfavourable or unfavourable comparisons between the average Chinese city and New York and, for example, its transport system. So some quite spicy comments online, and a lot of memes as well that are emerging of J.D. Vance behind a sewing machine, you know, making shoes and things like that.
We do have to put out that disclaimer that the Chinese internet is highly censored, so you're going to get sort of weighted comments to the narratives that might come out of Beijing. But what are some of the more influential bloggers or commentators saying about the Trump tariffs?
Yeah, this is a really interesting point too. But to your point about some of the sort of controls and mechanisms to shape narratives here, we do seem to see quite a coordinated reporting from two influential bloggers, as you say. One of them is so-called Chairman Rabbit, who is really the son of an influential, or the grandson of an influential Guangdong party official. The other is a senior editor at Xinhua's website. They've both put out comments essentially extending the ways in which China could hit back if the US does go through with this, in excess of 100% tariffs on China. Now, some of those are extensions of measures that already exist. You can take a look there. So, for example, suspending cooperation on fentanyl-related issues, increasing tariffs on things like soybeans, sorghum, entirely banning US poultry. These are sort of intensifications of things that are already in the works or in play or in discussion. And then there are newer measures that are also being discussed, which include, for example, banning US films from being shown in the US, as well as restricting US services from accessing China. And just to say the quiet part out loud, the obvious thing is here, when we think about the priority for Trump and reducing the trade deficit, when we think about restricting US services access to China, reducing the amount of US tariffs, I mean, these are things that work exactly in opposition to try and rebalancing the tariff. These are things that, will prevent China from actually rebalancing the trade deficits. They're moving very much in entirely the opposite direction. Just to put say the quiet part out loud here when we think about how we recognize. But as I say, it does seem like quite a coordinated and pointed effort, because we do have these two separate bloggers both citing unidentified sources as potentially contemplating this response from China.
Maybe a trial balloon or two on the internet, right, to see how it goes. Well, balloon maybe is the wrong word to use.
Yeah, but maybe not even bring that up right now.
Let's not forget the balloon. Okay, Bloomberg Asia economy and government correspondent Rebecca Chung-Wilkins, thanks so much for your insights. And we can also turn to the Bloomberg for more on this. Go to TLive Go to get commentary and analysis from Bloomberg's expert editors. Got a few minutes left in the second hour of the China show, and just about an hour and 10 minutes or less until those U.S. tariffs take into effect. Plenty more ahead. This is Bloomberg.
They don't want tariffs on themselves. And it's very simple. We're making deals, and people are paying tariffs. Countries are paying tariffs. Right now, China is paying a 104% tariff. Think of it, 104%.
That was President Trump speaking earlier at the National Republican Congressional Committee in Washington. And wow, this is the final countdown, Steve, really, until these tariffs take effect. So we're just over 1 hour's time away now. I mean, we can't say it enough. 104% levies going on China. But this is really broad-based. And you can see that in just how many economies and markets are feeling the pain of this today, because, I mean, this is taking a look at some of the Apple suppliers, for instance. It's that big diversification story. Are we going to see Apple planning to shift more production from China to India, for instance?
Yeah, because China's not getting 104% tariffs, but they are getting tariffs of their own. Maybe there's some negotiation going on as well. But Vietnam and others have also been part of Apple's supply chain, Malaysia, you name it, and obviously Taiwan, too.
Yeah, and then you think about, what else is a big supply chain is the apparel makers. And Nike as a company is so emblematic of this, because, they are producing in these factories, Bangladesh, for instance, lots of other markets, Vietnam, for instance. Again, these are seeing downside pressure. And then lastly, Tesla, and this wraps in a lot of different themes, including just, are you starting to see some signs of issues amongst Trump's closest advisors?
Yeah, and a big question, too, Elon Musk and Tesla expected to get full self-driving approval in China this year? I'll leave it at that.
Yeah, well, we will have plenty more ahead, as we said, those U.S. tariffs taking effect. This is the countdown. Stay with Bloomberg. We'll have all the latest.